Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, we're getting into the myths. We talked about stock picking. We talked about track record investing. Next, we're going to talk about market timing. All right, when it comes to market timing, this is one of those that I see most common. This is where, I've had many clients come in for the first time. When I see them for the first time, one of the things they're saying to me is, I've kind of been sitting out. I sat out a lot of this market, this last bull run. In fact, a lot of people around the election got very nervous in the months leading up to the election and at the time of the election, and they got out of the market at that time concerned about the uncertainty there. At that time, there was also uncertainty with what was going on with the Federal Reserve, and the combination of those two things had a lot of people sitting on the sidelines. Basically, what does that mean? It's about market timing. It's a really difficult thing to do as far as timing the market. In fact, it's impossible. Okay, you trying to figure out when to be in the market or outside the market actually costs investors a tremendous amount of money. And this is an example of that. How much the market has had this tremendous run up that no one predicted. Of course, no one saw coming. In fact, the opposite was what the belief was coming out of an election. And to see these type of records being held, it's got and these new highs being hit. Dow 25,000. Oh my goodness, right? Well, what does it mean in terms going forward? This is another concern, right? How many new people coming in, all right? And maybe you're sitting out there and you're thinking these same things. What's going to happen with the market? It seems so high. Can it, certainly it can't go on like this forever. Certainly it's going to go into some kind of down market, that we're going to have a bear market. Is going to be some kind of bubble bursting here. Are there fundamentals there to support what's going on with the market? There are many analysts that are saying yes, the profits are there and the market is, could continue to go up like this. We're seeing the deregulation and the changes in corporate tax rates, and so that could help as far as continuing this bull market. Now let's take a look at it historically. What's happened if we look at what in say the 80s and 90s, an example. These were the two biggest back-to-back decades in the history of the stock market. Now at this time, I recall back in 2000, clients were coming in and they were saying, the market started going down. They were getting very concerned. And then through 2000, they're just thinking, well, we're going to ride this out and it'll be fine. And then we're into 2001 and the market's still going down. They're saying, oh my goodness, when are things going to get back to normal? And what was normal, by the way? In the 80s and 90s, we had double-digit returns, okay? In planning at that point, after 20 years of such returns, in the teens on an annual basis, compounded, right? We're thinking, a moderate portfolio back then would be 10 to 12% a year. All right, it was quite a period in time, the biggest back-to-back decades, I say, in the history of the stock market. Then we had 2000 through 2009, and in that period, all right, the market, it flattened. I mean, you got no return, okay? In fact, a negative return for many. So what does that tell us as far as, so we had these two huge decades, now we had this negative decade, the lost decade is referred to. Now we've had the period since when the market's had this really incredible run. And it's gotten even better, of course, here in just in the last year. Tremendous amount of growth, about 25%, 25% in fact, just in the last year. That's pretty amazing. So how do you put all this into context when it comes to investing? We don't know, right? We don't know whether maybe we are in a period like the 80s and 90s. Maybe we'll have that kind of a run, or maybe we'll see another downturn, another bear market that'll come up in the next year or two. Who knows, right? One of the things we know then is when it comes to investing is this is the time to make sure that you're invested correctly. And we have the academic research that shows us an example again at 2000 through 2002 period. The market dropped at that point 45% over that 3-year period. Well, guess what? If you were in a moderate portfolio over the same period, utilizing asset index funds, all right, so asset allocation done right though with the academic research we have, if done correctly over that same period, a moderate portfolio actually was at about a break even. It didn't lose any money at all. It was like, I don't know, fractional, maybe down 1% or something, all right? And then what happened, of course, in the very next period, so that was 2000 through 2002, then in 2003, boom, it's up above the market, where it took until 2007, at the end of 2007, in fact, before you saw a recovery in the S&P from that bear market. So these are some of the things to keep in mind when it comes to investing, and why I'm taking this time to share this information with you so that you can, in fact, be invested properly, all right? Use this academic research. We've got it there, 50 years of Nobel Prize winning academic research showing us how, in fact, to construct a portfolio, how to use asset allocation properly, be well diversified in our portfolio, and make sure, in fact, that when the next bear market comes, you're going to be able to ride it out. Not only that, if the market keeps going, you're still going to benefit, right? You're going to be making money too. All right? This isn't about sitting out, and that's what market timing comes to. All right, so let's take a look at that slide again. So when it comes to market timing, this is where we're, again, when someone's coming in, they're saying, well, what's market timing? Excuse me, what do you think the market's going to do over the next year? Do you think it's, are we in fact due for a big downturn? Again, I don't have a crystal ball. No one does. No one can forecast the future about what the market's going to do. All right, it's looking really good right now, which is great for everyone. This is also a good time to make sure that you're properly allocated as far as your portfolio, and that you don't have a lot of hidden bombs in there. I'm seeing a lot of portfolios that come in for the first time when we look at clients' portfolios. Active management, large caps, mainly heavily weighted in large companies, not much diversification there to missing out on. The next is on the bond side. We're seeing a lot of risk there, a lot of long-term bonds, a lot of junk bonds where they're trying to seek to get a higher return in this low interest rate environment. So these are all risks that you're taking that may be benefited in over the short period, but long-term could be very, very detrimental. All right, so when it comes to Dalbar Research, basically Dalbar is an independent research group, and one of the things they do is look at investor behavior, and they look at the results that investors get. And each year they have a report that they put out that goes into this qualitative investors. And one of them is this. All right, this is showing, in fact, the S&P 500 index. Okay, over the last, in this period we're looking at the last 30 years, average return about 10%. And yet look at the average investor in mutual funds, 3.98%. Okay, that's less than half, okay, a return for the average investor. And why is that? What is the reason that the average investor did so well, or did so poorly compared to the market? Well, let's take a look at the next chart. And this is why market timing doesn't work. One of the things, we just talked about the big run up in the market. And if you've been sitting out in the market, or maybe you got in at some point, who knows, you missed out on a lot of this run up, let's say. This is one of the, this chart shows us, in fact, if we look over this, what is a 20-year period here, okay, from 1997 through March of 2017, there were over 5,000 trading days, 5,040 trading days that the market was open. And as the chart's showing, if you miss just the 10 best of those days, all right, and when do those best days tend to typically occur? It's when the market is heading back up after a bear market or after a downturn. And that's where people, now think about that. If you're timing the market, what are you doing? You're saying, well, the market's making me nervous. It's so high, I'm going to get out. And then maybe you miss out on a bit of a run up. And then maybe the market does go down. Now, do you jump right back in? No, because you're not sure. Well, does it hit the bottom yet? I'm not sure. I'm not sure. I'm not sure. So I'm going to wait. I'm not going to jump in yet. I'm going to wait until what? The market starts going up again. And then when the market goes up, starts going up, do I jump right back in? No, I want to make sure this isn't going to just like be a little what they call a dead cat bounce. It's an unfortunate term, but what they talk about in the market where it starts up but then drops back down again. So we're worried about that. So now we wait some more, and then the market's going way up, and then, okay, now we'll jump back in. Well, what happened? We missed out on some of the best days in the market, and those are huge days that make all the difference. In fact, if you missed just those 10 best days over a 20-year period, you would have got half the return. You would have cut your return in half. If you lost 20 days, you would have cut it even further. And if you missed the best 30 days out of 5,000, over 5,000 days, you would have got maybe 20% of what everyone else got, or if you'd have stayed invested in what you would have received then. So what do we know then about market timing? It just doesn't work. If you miss out on those days, you have to stay invested. But to stay invested, proper asset allocation can make the difference. Because if your portfolio doesn't drop like the market drops, drops a fraction of that, half of that, or maybe less even, maybe 1/4 of that, depending on your asset allocation, all right, then that's going to make it a lot easier for you to ride out these bumps, all right? They're not going to be as big a bump, for one thing. Let's take a look at another thing. It's called tactical asset allocation. This is another form of market timing, all right? We're talking about first, what if you just sat out completely? You just say, I'm going to put all my money in cash and I'm not going to invest in the market right now. I'm going to wait because I think the market's going to go down, and when it does, I'm going to get in then. That's the thinking. All right, and guess what? You're not alone. Even if you're one that says, well, I'm going to stay invested in the market. Well, if you're invested in active managed mutual funds, guess what? Maybe your money managers are going heavier in cash, and they're ones that are going to try to time the market. And this is one I've seen quite often as well when we're doing analysis of people's portfolios. We see that the money managers they have are doing things that they on themselves wouldn't do. They're thinking they've got this handled by staying, buying and holding, but their money managers are not. And sometimes the money managers do another thing, and this is where what we call tactical asset allocation. And what this means is basically maybe they're heavier in large caps, and all of a sudden they decide they're going to shift that around and go into a different asset category. Or maybe they move out of small caps and other asset classes and go heavy into large caps because of the way the market's running there. This again is just another form of market timing. The concept is understanding this. When you're investing in the market, we want to come up with an investment plan, all right, that meets your situation, all right? It's specific to you. And how we do that is we look at what everything, right? We look at your income, we look at what your expenses are, we look at your assets, your liabilities, all right? We take all that into consideration before coming up with an investment plan, because we're going to find out what's the needed rate of return on your investments to attain and maintain your standard of living and quality of life no matter how long you live, and then what's the safest way to do that. And I'm going to give you another offer to take advantage of that when we come back. But first, we're going to take a quick break. Join us here. We'll be right back on the Retirement Report.